Welcome, everyone. We have a very special guest here today with us, Toby Carlisle. Welcome to our talk at Google at Author Series. He's going to be talking about his new book, Deep Value: Why Activist Investors and Other Contrarians Battle for the Control of Losing Corporations. Toby has a unique perspective on value investing, much like Google's. His approach to value investing is data-driven, just like Google's approach to engineering. In his book, he uses statistical analysis and in-depth research to give evidence for a simple yet counterintuitive idea. Losing stocks with failing businesses and uncertain futures can sometimes offer unusually attractive investment potential. His work in this area is very much like Ben Graham's classic work in his 1934 security analysis book. The funny thing about classics is everyone's heard about them. Very few people have actually read the classics. Toby is one of those rare few individuals, investors, I would say, who's been living and breathing Ben Graham's deep value investing philosophy. So please help me welcome Toby Carlisle.
Thank you.
Oh, yeah, you are.
Hi, folks. Thank you very much for having me here today. I'm very much looking forward to speaking to Google. Just a little bit about me. My name's Tobias Carlisle. I'm the Managing Director of Equum Investment Management, and I manage the fund and some separately managed accounts. My most recent book is Deep Value, and before that I published Quantitative Value, co-authored with a gentleman who did his quantitative research through Booth. I blog at Greenbacked, and I'm just launching a new site called The Acquirer's Multiple that is yet to go live. The talk today proceeds in 4 parts. The first part we're going to discuss is the philosophy of deep value, what it is, its genesis. Then we're going to look at some of the behavioural reasons that stocks become undervalued in contrarians at the gate. Third, we're going to examine some ways that we can avoid making those behavioural errors that create undervalued stocks. And finally, we're going to examine a simple metric for generating outstanding returns in the market. In 1927, a 33-year-old Benjamin Graham started teaching a night class at Columbia that he called security analysis. He offered practical counsel for the students who took the class, but the thrust of what he taught was that a security had an intrinsic value and it was distinct from its market price, which you could observe on the stock market in any given day. And he argued that when there was a sufficient mispricing, either the price was at a discount to the intrinsic value, or in some instances where the price was at a premium to the intrinsic value, you could trade long or short and rely on the fact that there would be some mean reversion to bring the price back to intrinsic value. In 1929, the stock market had its worst crash. It continues to be the worst crash to date. From its peak to its trough, it fell almost 90%. In 1932, fully 3 years after the bottom of that crash, the stock market still hadn't recovered. Graham authored a series of articles for Forbes magazine where he pointed out some research that he had undertaken that said that of the 600 issues on the stock market at that time, 200 of them traded for less than their liquidation value. So they traded for less than what the shareholders in those companies could get out of them if they wanted to wind them up. And then a sizable portion of those traded at a discount to their net cash backing, which is after paying out all of the liabilities of the company, there would still be cash left in a bank account and you could buy the entire company for less than that amount. And he said, he likened it to corporate gold dollars being traded for 50 cents or less with strings attached. And that sort of enduring, iconic image continues to be the way that we think about value investing, that it is an attempt to buy a 50-cent dollar. Some years later, John Burr Williams added some additional colour to the way that we go about valuing a company, and that is to look at all of the cash inflows and outflows discount them back to the present day, and that gives you an intrinsic value. So as you hunt in the market for these particular stocks, you can find those at the greatest discount to intrinsic value will tend to underperform, and those at the greatest premium to intrinsic value will tend to underperform. So this chart shows if we rank every stock in the universe, and this is a global universe, so 22,000 positions, if we give them all a ranking, price to cash flow, price to book, price to earnings, we take the average of those and then we rank them into 5 groups. The glamour quintile, which is the most expensive, tends to underperform on average, and the value quintile, which is the cheapest, tends to outperform. So when we're seeking to invest in these companies, one thing that we can observe is that price tends to fluctuate more than intrinsic value, which only moves much more slowly. And so when you find these occasional moments when there's a large discount or a large premium, you can invest to capture that discount. The question that I'm often asked is, what is it that causes the discounted price to return to its intrinsic value? And it's a question that Benjamin Graham got when he was appearing before a Senate committee in 1955. And the chairman said, how do you close that gap? Is it by advertising or what happens? And Graham gave one of his great answers where he said, it's a mystery, and it's a mystery to him as it is, as much of a mystery to him as it is to everybody else. But we understand it to mean mean reversion. And so what this talk is about is what are the actual mechanics of mean reversion? What are the things that make mean reversion occur? So this is actually Graham's list. So he talks about in 1, that's just general improvement in the industry. And this is a very common occurrence that the industry's in a trough, the business is in a trough, it's got a period of bad luck, perhaps some bad management, and either the incumbent managers turn the company around or external managers are brought in. Less commonly, a sale or a merger or some sort of liquidation. Sometime later, behavioural researchers DeBont and Thaler examine securities on the basis of a variety of different metrics, but they're looking particularly in this case for undervaluation and overvaluation measured by price to book value. So they found that by selecting the decile, which is 1/10 of stocks that were most undervalued, and the decile of stocks that were most overvalued, and then examining the trend in earnings per share, you find this unusual phenomenon where the earnings for the most undervalued stocks have been falling for the years previous to the portfolios being formed. And for the most overvalued stocks, they've been increasing. And that's the reason that one is overvalued and the other is undervalued. But then this very unusual thing happens once the portfolios are formed. The overvalued stocks still continue to grow, but they slow a great deal. And the earnings per share of the undervalued stocks begin to improve at this stage. And 4 years hence, on average, the undervalued stocks, which have been selected simply based on their undervaluation, have actually earned more and are earning more than the overvalued stocks, which had the highest rate of growth. It's a phenomenon that we see over and over again in the research. So this is another interesting study subsequent to the DeBont and Thaler research by Lakonishik, Schliefer and Vishny. They said, well, if it is in fact the case that there is this mean reversion in the fundamentals of the business, if there's mean reversion in the earnings, if the undervalued stocks do start creating earnings growth and the overvalued stocks earnings slow, then what if we went and selected portfolios specifically on, we could find an undervalued portfolio with very slow growth, an overvalued portfolio with very high growth, and an undervalued portfolio with very high growth, which would be the better portfolio? So they sorted the universe into 3 portfolios on the basis of valuation, from most overvalued to the median, average, and to the most undervalued. And then they divided each of those portfolios into the highest rate of growth, the mid rate of growth, and the slowest rate of growth. So there were 9 portfolios formed. I've selected 3 of them here to show you to show you the phenomenon. So the Glamour portfolio has the highest rate of growth, and you can see in earnings, cash flow, book value, operating earnings, all of those are growing higher than the other two value portfolios. But you can also see that you have to pay a higher multiple to acquire these stocks. So they're 19.6 times, 10.8 times cash flow. They're expensive stocks. On the other end of the scale, these are two of the three value portfolios. The high growth value portfolio is still growing at quite a high rate of growth, but it's available for a much cheaper multiple. And the contrarian value portfolio, which is the very low growth portfolio, growing at a low rate and available on a low multiple. So as you would expect, the value portfolios outperform the Glamour portfolios. But this is the really interesting thing. The low growth, undervalued portfolio outperforms the high growth, undervalued portfolio. And this is something really unusual, and I think it's something that is a little bit counterintuitive because we sort of like to think that high growth, undervalued stocks are bargains, gems in the rough. And it turns out that mean reversion acts on those portfolios as well to pull the high growth back and to improve the low growth. So this is just that previous slide with the Glamour portfolio removed, just so we can see specifically. And the thing that I want to draw your attention to here is that the contrarian value portfolio in many of these categories is actually a little bit more expensive than the high growth portfolio. The reason possibly is that earnings are a little bit more anemic, cash flow is a little bit more anemic. So you can see on the book value basis, the high growth value portfolio was slightly more expensive. But it's very definitely growing much faster than the contrarian value portfolio. So the real driver of returns here was the undervaluation and not the rate of growth. And then there was some mean reversion as well, which pushed down the high rate of growth and made the high growth value less attractive over a period of time compared to the contrarian value. This was an earlier examination conducted by Michelle Clayman. There was a book written by Tom Peters that came out in the early 80s called In Search of Excellence. And Peters said that he'd identified the characteristics that created excellent companies. And he looked at a variety of these sort of quantitative financial type elements. The book has been described as the book of the century, possibly by Tom Peters himself, but I've never read it. But I've read the research, and the research is compelling. These are his criteria for an excellent company. So they have very high rates of asset growth, very high rates of equity growth. They're expensive, and they have excellent returns on capital, assets, and equity. So Clayman said, well, let's create the opposite portfolio. Let's call them unexcellent companies, and we're going to find those with the worst asset growth, equity growth, low valuation, anemic returns on capital, equity, and assets. And then we're going to track their performance over a period of time. So the thing that I draw your attention to is just the valuation alone. And you can see here, this is some research that appears in the book. It was conducted by Barry Bannister at Stifel Financial. The unexcellent portfolios have vastly outpaced the excellent portfolios. For an early period of time, and it's difficult to see on this chart, the excellent portfolios did actually outperform the market, but not since. You get a better return investing in the S&P 500 than you do investing in these very high quality, high growth companies, these excellent companies. And you get a much better return investing in the ugliest of the ugly. The question that naturally people ask when they see that data is, well, is there some advantage to investing in the excellent portfolios because they offer some sort of risk protection? Is it a downside protection phenomenon? Is it that when the world goes into a recession, you want to be in these things that generate higher rates of growth? And the answer is no. Bannister looked at periods where the global growth was below average and above average. So above the line is when the shaded areas where global economic growth is below average, and the lighter areas where global economic growth exceeds the average. And you can see quite clearly, there's no real method to when unexcellent outperforms or excellent outperforms. It does outperform occasionally, but it doesn't necessarily need a bad state of the world to do so. So I always like to use this motif to sort of describe the nature of what occurs in these undervalued companies. Most companies are going to go through this cycle. There are a very small number of companies that can avoid this cycle, but very small number of them. This is from a woodcut from Albrecht Dürer in 1494 from a book called The Ship of Fools, which is about some fools on a ship to a fool's paradise, and they go through it. They have a number of follies, and one of them is hubris about where they are and disregarding the role of luck in their own lives, good and bad. So the wheel, it's the wheel of fortune. That's Fortuna's hand puppeting the wheel in the top left-hand corner. The ass at the top is Regno, Irene, and you can see that he's at the very pinnacle and he's about to descend down the other side, but instead he reaches out for the sun. And this is what, in the academic financial literature, they describe as naive extrapolation. You imagine that your current state will continue on when, in actual fact, mean reversion is a much more likely outcome. So the next Renyavi, Irene, he's slowly turning back into a man as he descends down the other side. And this is perhaps where deep value investors want to stake their claim. Sum sine regno, I am without a kingdom. He's not even visible on the woodcut. And then back up the other side, Renyabo, I will reign. Maybe that's another good time to invest too. So if what we're looking for is fundamental weakness, declining earnings, and undervaluation, the thing that makes them difficult to buy for other investors makes it equally difficult for us to buy. So how can we avoid making the behavioural errors that other investors are making? How can we not be the naive extrapolation investor and become the contrarian value investor that captures that upside performance from buying companies with ugly fundamentals? There's been a great deal of research into this area of the role of statistical prediction models and experts. It's a counterintuitive area of study for this reason. So a professor went and studied 1,000 admissions to hospital of depression or psychosis, and apparently on initial presentation they can appear very similar. Then there's a subsequent diagnosis several weeks or months later where they're able to determine properly whether the patient who presented was in fact psychotic or depressed. So he created, by examining the admission records and the subsequent diagnoses, he created a simple questionnaire that could be administered by psychologists when these people presented to the hospital, and they could make a determination. So without the benefit of the model, the worst psychologists got it right about 55% of the time, on average about 62%, and the very best psychologists got it right 67% of the time. The simple model in backtest got it right 70% of the time. The professor distributed the questionnaire to a variety of different psychologists in the hospital. There were two. Basically, they were inexperienced, who were students, and then there were clinical psychologists who were actually treating patients. And they found that without the benefit of the model, the inexperienced students got it right about 59% of the time. The experienced clinical psychologists got it right about 64% of the time. The inexperienced psychologists, with the benefit of the model, but the ability to override the model's output, got it right about 2/3 of the time. And the experienced psychologists, with the benefit of the model, got it right 75% of the time. But this is the really incredible thing. The simple model by itself outperformed all of them. And the reason is that we make errors when we attempt to apply a model and we don't follow the model's output, and that leads us to underperform what the simple model does by itself. The reason that when people observe this research, they often say, if you have a case that's so different from the base rate, from the statistical research that you've conducted, doesn't it make sense then to be able to override the model? And the example they always give, you have some sort of algorithm that predicts whether John will go to the theatre on Friday, and now you know that he has a broken leg. Shouldn't you be able to factor that into your model to determine whether he will in fact go to the theatre this Friday? And the answer is no. And the reason is that we tend to find more broken legs than there really are. And particularly in this type of deep value investing, all of the stocks have what appear to be broken legs. You might be familiar with The Little Book That Beats the Market. It's a book by Joel Greenblatt. He took Warren Buffett's exhortation to buy wonderful companies at fair prices, and he translated that into a quantitative model that we'll examine in detail in a moment. But for the moment, you just need to know that it meant high quality, however that's defined, and good value. He had an experiment in his own firm where he handed out lists of the stocks selected by the formula, and he allowed people to either, in their own separately managed accounts, to either choose the stocks that they wanted or to have him apply the formula automatically. He found that the automatically applied formula did in fact outperform the market over 2 years, and by quite a substantial margin. He also found that when people were allowed to manage the portfolio themselves, they tended to underperform. And the reason is that they cherry-picked out the very best stocks, and they were the stocks that looked the ugliest. So you might say, well, they were not experts, they were people who were relying on his expertise. But then Greenblatt says, we attempted to do the same thing, and he found he had the same outcome. He underperformed his own model. So that brings us to the golden rule of statistical prediction rules, and that is that simple models outperform experts, but simple models continue to outperform experts even when they have the benefit of the model. When we're thinking about designing a quantitative system, there are several things that we need to be aware of. One of them is that the rules must be simple and they must be concrete. They must be simple so that they're able to be followed, and concrete so that they're able to be understood. This is a picture of a pipe. This is not in fact a pipe. This is a picture of a pipe. And when we're valuing companies, in many ways, this is sort of what we're doing. We're using some proxy, and there are a variety of different models or proxies that we can select. We can choose the liquidation value, we can look at the franchise value, the growth value, earnings power value, the acquirer's multiple. We can use any number of these simple multiples. But we're not really getting the truth of the company. And so it's important that we recognise first that there are limitations to the model. And recognising that the model is somewhat imperfect, we can recognise then that we do have some tool for making a decision. So the 80-20 rule does apply to information in investing too. You get 80% of the way there with a simple model. And the urge of most investors is to continue to find that final bit of information that will remove the uncertainty that they have. But often by the time that occurs, the uncertainty's been removed for everybody else as well. And so those low prices that you were attracted to are gone. So the simplest rule, I think, and one of the most effective, is the net current asset value rule. Graham wrote about this in 1934. He described it as a rough measure of liquidating value. So you can see, you look simply at the balance sheet, you ignore the earnings, the cash flow statement. It didn't exist at the time that Graham put this together, but you could ignore it for the purpose of this analysis. And then you treat only the current assets as having value. So cash is worth cash. Receivables, there's some discount applied to them. Inventories would vary depending on whether it's food that can spoil, fashion, high fashion that will be less valuable in 12 months' time, or something that's going to be continue to be valuable well into the future. And then you can look at the fixed assets and determine whether they have a value. The research shows quite comprehensively that net current asset value massively outperforms. And it's an extraordinary thing that is such a simple analysis. So the market in these instances is always a small capitalisation, micro-capitalisation equivalent to what we're looking at for the net current asset value stocks. You can see in the US, That's a study from the 1970 to 1983. The net current asset value portfolio did 29% versus 11.5% for the market. This is a study that I conducted in the US, 83 to 2010, just continuing on the second study. So it was a second 27 years. And similar sort of outperformance, maybe more so, which is surprising because you would think that with all of the access to information that a lot of these positions would have been arbitraged away, but they haven't been. They continue to exist in the UK, and they exist globally as well. But there are some unusual things that you find when you conduct this sort of research. The first one is that the individual net current asset value stock is more likely to go to zero than the rest of the market, and the rate is about 6% for a net current asset value stock versus 2.5% for the average stock in the market. But as a portfolio, there are fewer down years than the market. And this is perhaps the most controversial finding, the most counterintuitive, and that's that loss-making net nets actually outperform net nets that are profitable. Within the profitable net nets, those that don't pay a dividend outperform the ones that do pay a dividend. So your instinct might be to find a net net that pays a dividend and with positive earnings, and that would lead you to underperform what you can do just by net nets alone. So many of you will know that Warren Buffett started out as a student of Benjamin Graham's. Then he worked with him in his Graham-Newman Corporation, and then he went out and he set up his own partnership. And in the early days of his partnership, he was very much a Graham-type investor, looking at liquidation value. The first position, one of the early positions that he put into the fund was Sanborn Map. It had a portfolio of securities, and it was trading at 65 cents on the dollar of that portfolio of securities with no value given at all to the business, which was making about $100,000 a year. He got on the board, he got control, he liquidated the security portfolio, paid it out in a tax-effective manner, and so he got a 50% return just on the portfolio, and then the business remained, and the business continues to exist to this day as a geographic information system business in the US. He had this evolution after meeting Charlie Munger, and in 1963, he found American Express mired in a scandal. So American Express is a financial company, and it had provided some warehouse receipts to Anthony Tino DeAngelis, who was a commodities broker and trader, and he had figured out that he could bring soybean oil to the port, show the inspectors that his tanks contained soybean oil, and then through pipes and valves he could fill up with seawater what had been soybean oil. And then they would check a new tank and it would contain the old soybean oil. At one stage he controlled almost 10 times more soybean oil than there was in existence. And that was the secret to his low prices. Eventually he went bankrupt. American Express had said that the warehouses did in fact contain the salad oil. His broker went bankrupt when the people who had lent against those warehouse receipts came looking for some deep pockets. They found American Express. And American Express owed something in the order of $175 million, which was 10 times its average annual earnings over the last few years. So there was a real risk that American Express would go bankrupt at that stage. Buffett put 40% of his portfolio into the stock. It recovered. He bought $13 million worth of that stock. That position today, if he had held it, which he didn't all the way through because he's changed investment entities, but that position today is worth something in the order of $14 billion, which is an enormous return. So he learnt from that it wasn't necessary for these things to have a liquidating value. He could, in fact, buy them on the basis of a franchise. He made sure that people were still continuing to use American Express cards. And so it taught him that there was a different method of investing. So in 1972, he found See's Candies. It was earning something like $2 million on $8 million of invested capital. They paid $27 million for it. He assessed the value in the order of $45 million, so he got a fairly substantial discount. And he said at the time, when someone asked him about it, are you still a Grahamite type investor? He said, I'm 85% Graham, 15% Phil Fisher, who recommended the scuttlebutt method of investing, which is you go and find as much information as you can about the quality of the business and its ability to grow. So See's Candies between 1972 to 2011 returned $1.35 billion to Berkshire Hathaway, which they've continued to invest. And it's required only something like $70 million reinvested in the business to generate those earnings. So that's what's known as a franchise. The lesson that he took from investing in See's Candies was that you're much better off with these businesses that are able to grow over a long period of time. He said, though the cigar butt might have a single puff left in it, and that puff is pure profit. After you've smoked that puff, there's nothing left. So he stopped being a cigar butt investor and he became an investor in wonderful companies at fair prices. Looks at Buffett's investment methodology and says that's been very lucrative for a very long period of time. Assuming that we don't have Buffett's great mind, are we just able to create a quantitative version of the methodology that Buffett describes in the little book, in his letters? And he wrote a book about that process. And so he decided that good quality as defined by Buffett means a high return on invested capital. So invested capital is what it actually costs to run, the money that you need invested in the business to run the business, the assets of the business that are actually used to produce income. The higher the return on invested capital, the better the business, the faster it's able to grow. And for valuation, he uses an earnings yield, earnings before interest and profit, interest and taxes, because it's agnostic to the capital structure, where interest payments on debt affect the tax that you pay. If you back out interest and tax, then you get this idea of the operating earnings that are coming into the business. We tested this in quantitative value, and we found that the magic formula does in fact beat the market, a comparable market of stocks, and quite comprehensively. It's beaten it by 3.5% each year from 1974 to 2011. What is really shocking is that the earnings yield alone, what I describe as the acquirer's multiple, beat the magic formula itself, and the quality measure actually underperformed the market. The quality measure actually led the magic formula to underperform the earnings yield alone. And it's not just a performance, it's not just a raw return story, it's in fact a risk-adjusted return story as well. The earnings yield alone generates a better Sharpe ratio and a better Sortino ratio, which is basically the amount of growth relative to the amount of variability in the returns. So you get better returns and you get better risk-adjusted returns just using the earnings yield. And the reason is that there is this mean reversion in return on invested capital. So Michael Mauboussin has tested this. He's examined a number of the 1,000 largest listed stocks in the US, ranked them in order of return on invested capital, and then divided them into 5 groups. So the very highest, and then he's ranked them into very highest and the very lowest. And then he's examined those same companies 10 years hence. And what he finds is that the highest return on invested capital mean reverts towards the mean return, and the lowest return on invested capital also slightly improves. So I think of the highest return on invested capital as being Regno at the very peak of the wheel and Sumsino Regno at the very bottom of the wheel. So what is the acquirer's multiple? Well, it's the enterprise multiple. The reason it's called the acquirer's multiple is it's the metric used by leverage buyout firms, private equity firms, activists to look through into the hidden value of the business. And in terms of the mechanics of it, it's market capitalization plus debt, because the business has to fund the debt. You're able to use the stock. You're able to use the cash to pay off the debt. You're also liable for the preferred stock. You're also liable for any minority interests and underfunded pensions, off-balance sheet liabilities. So it's the real cost to buy the business. And then you get access to EBITDA or EBIT, which is the cash flow coming in. it turns out that it doesn't really make much difference which you choose. But when we tested them using data from 1964 to 2011, so we tested a variety of different possible metrics. Earnings yield, which is the inverse of the price earnings metric, just to highlight the two. The acquirer's multiple using EBIT, the acquirer's multiple using EBITDA, free cash flow on enterprise value, gross profits yield, so that's just revenues minus cost of goods sold to give you the third line on the income statement, and book to market, which is the inverse of price to book, so that they're arranged in the same way. We found that the acquirer's multiple outperformed. And again, not just on a raw return basis, it outperforms on a risk-adjusted return basis too, and comprehensively. The four things that I want to take away from today are that the very deepest undervalued stocks outperform the highest quality and the highest growth, even in the undervalued portfolios. So undervalued portfolios divided into high growth and low growth. The low growth undervalued portfolios will outperform. So it's better to be assuming that there's going to be some mean reversion, positive and negative, rather than to naively extrapolate out the growth in earnings. Simple models applying these ideas will always outperform expert discretion. So at the beginning of your process, you decide what is important in the assessment of value, and then you rigorously apply that without fear or favour. And the acquirer's multiple is the best multiple. If you're looking for a very simple application, a very simple rule, this is a very good one. It's a plug for the book. So I go into these studies in a great deal more depth in the book. Each one of them, there are several different versions of the studies, so you can see as we go through the entire book. The site acquirer's multiple has a place to capture your email and your details. If you'd like to learn more when it's up and going, it'll basically provide a free screen of acquirer's multiple companies and some commentary and some research as it goes along. So if you have any questions, I'd be happy to hear them.
This question is about the mean reversion. And amongst this universe of companies, do you think there are some particular companies or industries that are more flexible towards mean reversion and others that are not? Or do you think it's the entire universe that just mean reverts over there?
There are certainly some companies do demonstrate persistence in their ability to maintain a high return on invested capital. And the question is that if you look at a large enough universe of stocks, would you just expect that there would be no persistence at all, or would you find some just by random chance? So it's not entirely clear whether there's a reason for their persistence or whether it's just the luck of looking at a 10-year period. Malbison has looked at that specifically, and he found that pharmaceuticals and biotechnology and another group did sort of demonstrate some persistence, so they kept the high returns on invested capital. But he wasn't able to determine the factors that, so prospectively, if you look at a data set without knowing the outcome, can you determine which ones are going to persist and which ones are going to mean revert? And he hasn't been able to do that yet.
You mentioned that the EBIT divided by EV is actually better than the magical
Yes.
than the magic formula. Is Joe Greenberg aware of that? I cannot imagine that he doesn't know that, right? It doesn't make a lot of sense to me.
He's almost certainly aware of that.
But you think he knows that, but he still put ROIC into the book.
Well, the magic formula does outperform. The magic formula does beat the market.
Yeah, but I'm sure that he also has done the study on the separate metrics, right? Do you think he hasn't done that?
No, I'm sure that he has.
But okay. I guess.
So why do it that way? Well,
yeah.
You know,
Do you understand my question? Yeah.
I do. There are elements to the business. It's a marketing business as much as it's a return business.
But I have the impression that Joe Greenblatt doesn't really, I mean, he has enough money and he doesn't really care about making more money. I could be wrong. Yeah.
In different states of the world, different, the magic formula will outperform the earnings yield. So when the markets are racing up, in a bull market, it's about even, but there are some periods of time, the late 1990s, for example, which was an unusual period in the markets, but the magic formula did outperform the pure earnings yield. But the earnings yield has outperformed the magic formula over the last 15 years. So it may be a job security type idea that if you apply the magic formula rather than the earnings yield, you have fewer years of underperformance. When I test that, that's not what I find. Basically, the earnings yield outperforms the magic formula pretty consistently, and pretty consistently over 5 and 10 year rolling periods. I think it's the better metric for the reason that I've sort of outlined here, that return on invested capital, mean reversion, is a very real phenomenon. And it's an easily explained phenomenon. When you find companies that are very profitable, it invites competitors to go into those industries. And industries that are low return, people leave the industry. Now, that happens all the time. That's happening right now in the oil and gas industry with low rates of return because the oil price is so low. They'll stop drilling holes. So that has a flow-on effect.
Joel Greenblatt talks about the fact that a lot of these economical companies are too cheap and don't have enough liquidity for the fund managers to own, and also that a lot of the fund managers just want saleable product. That's the popular names and so on. So could you comment on the liquidity issue and moving in and out of some of these smaller issues?
The book, The Little Book That Beats the Market, shows a return for the magic formula that's much higher than you can achieve if you adjust for liquidity and for size. But you can still get outperformance applying it in a very large capitalisation universe and market capitalisation weighted, which means you size the positions in the portfolio relative to the market capitalisation of the company that you're buying rather than equally weighting them. So that means that you're putting more money into the bigger companies. So you sort of, that is testing for precisely that problem. So the results that I was showing in here were actually market capitalisation weighted. So you get slightly better results again if you equal weight, for the simple reason that you're putting more money into smaller positions. Mm-hmm. So market capitalisation weighting sort of adjusts for that. The problem with something like the net current asset value is that it's really not an investable strategy for anybody other than an individual. They're just not around often enough, and they're not big enough or liquid enough to sort of invest in. You know, if you have $1 million of investable capital, it's probably too small for you. But the magic formula and the acquirer's multiple scale beautifully. You can take the acquirer's multiple in an S&P 500 universe, select the 5% or the 10%, so the 25 or 50 stocks in that universe, roll it once a year, and you'll find pretty consistently that you get quite a lot of outperformance doing that. So as a broad problem, liquidity and size are issues that reduce returns. But these metrics still do work in large universes. You just get the incredible outperformance if you're able to invest in the little stuff which small managers and individuals can. Right. Does that answer the question?
Yeah, that's a very good answer. Thank you.
So I think your last statement has answered a lot of my questions I was going to ask. But for the magic formula backtest, I would like to know the more details. So one is you said the rebalance is once per year?
Yes.
Okay. So how does the backtest deal with the survival bias?
That's a good question. So the database that we use, Compustat, keeps companies that have failed in the data. So if it failed in 1975, the backtester would have bought it in, it could have bought it in 1974 because the data remains in the database. So we do a number of things. In quantitative value, we outline in some detail the process that we go through to backtest. Basically, we do a number of things, like we lag the data. So one of the problems that you have is that you have this look-ahead bias, which is the possibility for trading on information that you don't already have. So And in addition to that, you have this January effect, which is quite pronounced. So there's some tax loss selling at the end of the year. And then if you invest, assuming that you can buy your entire position on the very first day of January, you capture quite a bump in performance. So what we did is we rebalanced the portfolios on June 30.
Okay.
And we used data from the preceding December. So we used the K data and we rebalanced in June. So we were avoiding that January effect and we were avoiding the look-ahead bias. And then we use a very good database. So
the basket is about 30 stocks in the basket?
it varies. So depending on the size of your universe, the universe, and depending on the size of how much you're investing and how much time you want to spend doing it, the fewest stocks that you could possibly do it with might be 20.
Okay.
And the most stocks, you really don't get much benefit beyond about 30. So somewhere between 20 and 30 is the appropriate size for a portfolio, equally weighted. And that also means that you can buy them on a quarterly basis. So you might buy, if you're buying 20, you buy 5 on a quarterly basis. And then you rebalance those 5, 12 months and 1 day to capture the tax effect. Or
Okay.
does that make sense?
Okay. Yeah. Thank you.
So if more people use the same strategy, wouldn't your strategy just be equals to the market?
Possibly. But Joel Greenblatt wrote that book in 2006. The magic formula doubled the return of the stock market last year. So the magic formula has continued to work. And the reason that it continues to work is that there aren't that many value investors out there. It's a niche strategy. And within that niche strategy, the deep value investment is a niche strategy. Most guys who are value investors would try to emulate Buffett. They're franchise type investors. There are very few guys who are really deep value guys. And there's also this problem that you'll find, and if you look at the data, I'll give these positions away for free on theacquirersmultiple.com, and you can go there and you'll be able to see they're quite frightening positions. You'll be buying very cheap iron ore mining companies. You'll be buying very cheap oil and gas companies. A few years ago, you would have been buying for-profit education. They're frightening to buy, and that's the real thing that drives the returns. That's why I went through that part of the presentation that says you have to follow the model. That's the most important thing. Without fear or favour, you can't cherry pick, because what you do when you cherry pick is you do what everybody else does, and you avoid the things that generate the really big outperformance.
Okay, I got a follow-up question. Have you tried the same strategy in different markets?
Yes. Okay. Yeah, so the magic formula works, and I discussed this in Deep Value, but the magic formula works in Japan, it works in the UK, and it works in Europe ex the UK. In each of those instances, the acquirer's multiple alone outperforms. The only place where that hasn't happened for the period of the data that we examined, which was about 14 years, because there just isn't that much international data. But Japan, the magic formula seemed to outperform the acquirer's multiple alone in that one single region over that 14-year period that we examined.
Hey, so I was wondering, what does your company do then? Do you just follow the model as well?
So basically, we have some additional things that we do. Quantitative value goes through quite comprehensively a very big model that you could use, and we sort of discuss. You can do things like avoiding companies at high risk of financial distress, avoiding fraud, avoiding earnings manipulators, looking for financial strength, looking for quality of earnings. So that's making sure that the cash flow into the business matches the accounting earnings. All of those things add a little bit of additional performance at the edges, but the big muscle movement, the big driver of performance is the acquirer's multiple. So yes, that's what I do, that's what I apply.
One question is why Warren Buffett moved to liquidator to operator? Is it because he had too much money? Another question is related to the first book of Joel Greenblatt. Like he's talked about the spin-off and also the special situation. I think his point is that just buying those would be good, but if you can pick your spot number, yeah, that would be better. I think his performance in 10 years was like 50%. That's the highest I've ever known. So then his ways like this is the area you want to pick from, and then you want to pick the best. Like then it's kind of not the same as what you are saying. What we are saying here, you're saying like don't involve any human being. Just buy everything, right? Yeah. Just want to know your.
His first book, You Can Be a Stock Market Genius, which is a terrible name for a really good book. The process that he describes in there is a reasonably complex investment strategy, and it's a strategy that really only a human being could implement at the moment, because it requires reading unusual filings and finding spin-offs or companies about to pay out a big dividend, special situation investing. I don't think that he could have invested as much money in that strategy as he can in the magic formula. And I think that that's a more difficult strategy to implement. You can certainly get expertise in an area and understand it better than another area. The spin-offs special situations are really a very broad basket of potential things that you can do, and you can become good in an industry or good at a particular thing. And that might lead to better performance. I sort of think that the broader your strategies and the broader your potential universe of stocks, the better performance you're going to have. I think to maintain that very high rate of return, he was paying out a lot of the capital that so he'd make the profit and pay it out and then do it again the next year. Whereas the magic formula is a compounding strategy. You roll over whatever you get, then you reinvest that compounded amount. And it's a strategy that really shows how good it is over a longer period of time, because you get to that point where you're investing larger sums of money at a higher rate than the special situation one, which requires that you keep on paying it out, and you're sort of limited a little bit in where you can apply it.
So the Warren Buffett question,
why did he change?
Yeah. Why he changed?
Possibly the challenge. Maybe he had too much money to invest.
Okay.
So one of the biggest criticism of any model created looking at backward data is you are fitting data, right?
Yep.
And the strategy that is outlined feels a bit like, oh, let's ignore quality and go for the liquidation value or the enterprise value or buying price of the company. And that could be a kind of a valid criticism. What would be your answer to that?
Well, we've looked at it in different markets too. So I certainly didn't go into it. It's not a great marketing strategy to tell somebody that what we're going to do is buy the lowest quality stocks that we can find, or not really care about quality. It's a much better marketing strategy to go and say, what we do is we look for really high quality stocks that are undervalued, and that's what we buy. Because that sounds like a really safe strategy to me. If you say I'm going to ignore quality, people think you're crazy. So I've written an entire book explaining why I ignore quality. So we didn't sort of set out to find that. It was just something that it's sort of unavoidable in the literature. You find this every single time you read. And I gave a sample of the studies in the book. There are a lot more studies in the book. There's another thing that looks at admiration. So what are your positive or negative feelings about a company? And they rank all of the companies on the basis of how liked or hated they are. And then they examine their performance over the following year. The most hated companies outperform the most admired companies. Morningstar gives rankings to companies. This is an A company, A+, this one's a B, this one's a D, this one's an E. The E's comprehensively outperform the A's. Every single time you look at research, and it's so counter to everything that you see everywhere else, where everybody's saying, find the really high quality ones. So I didn't go looking for it. But when you look at this sort of strategy outside of this market, you find almost the same thing. The one exception to that is Japan. For whatever reason, the magic formula over the period of the data that we examined outperformed the earnings yield alone. Japan's an outlier in a number of different strategies. Momentum hasn't worked in Japan, whereas that's worked in lots of other markets. But even though Japan has sort of been gently falling, this is just an interesting side comment, even though it's been gently falling since 1990, value investing strategies in Japan have worked really well. Just buying the cheapest companies on the basis of price to earnings, price to cash flow, price to book has done something like 20% a year. So the magic formula may have just captured a little bit more of that performance. But yes, there's always a risk of data mining in this sort of in this sort of stuff. I think that the acquirer's multiple is the way that value investors think about investing. So if you think about the way that you're instructed in security analysis or the intelligent investor or any of Buffett's letters, he says, think about buying the company think about buying the entire business. You're not buying a share of it, you're buying the whole thing. And that's exactly what the acquirer's multiple does. It says, this is what you pay for the market capitalization. But don't forget that you've got preferred stock, debt, minority interests, off-balance sheet liabilities, underfunded pensions, other things that you have to fund. But you do get the benefit of the cash that's sitting in the bank, or the net cash. And then you have this discretion to spend the operating earnings as they're coming in on CapEx or paying down debt or various other things. So it's looking at the same thing that big acquirers look at. And I often find that I'm in positions that somebody else has been buying right behind me. It's a Carlisle or another activist or a private equity firm, and something happens in them. Because when they get very cheap, there's a little bit of instability. It's not a situation that should persist like that. There's sort of inviting external managers to come in and try to rectify the situation. So data mining is always a problem, but I think there are a variety of reasons why this strategy should work quite well, and it does work quite well in different time periods and in different markets.
Buffett talks about holding stocks for the long term, and one of the reasons that he likes that is because of the tax consequences. Can you talk a little bit about the difference between trying to find companies that you can hold for a long period of time versus rebalancing and using the deep value strategy?
Well, this is one of the arguments this is what the franchise investors are trying to do. They want to buy that company that can sustain those very high returns on invested capital and ideally grow and compound away, throwing off cash while they're doing it, so that 10 years or 20 years from now, you're sort of getting out of it in dividends what you invested in it, and it's a much more valuable company. So if you think about the process of going and finding one of those companies, knowing that there's that mean reversion in return on invested capital, what would you rather buy? Do you want to buy one that has a very high return on invested capital that might mean revert? Or are you better off finding one that's very cheap, that might be at a trough, that you can hold for 7 or 8 or 9 or 10 years, that reverts up? I think you've got as much chance of selecting. The challenge is not to buy something that looks like it's high quality now. The challenge is to buy something and hold something that is high quality. So we all want to buy the same stocks. Maybe I haven't made that clear enough. Everybody wants to buy everybody wants to own the really high quality stock, the compounding machine that has the very high returns on invested capital. But can you use historical data to identify them? It's not clear, but what is clear is that buying the ones with high returns on invested capital don't necessarily turn into ones that have high returns on invested capital subsequently.
So one thing you talk about in the book is one of the reasons this strategy works is because of activist investors are kind of arbitraging into an alternate market where companies companies are being traded not because they want the stock to trade high, but because they want to take control of the company. And so activism is a pretty important kind of a catalyst to this strategy. What do you think about this strategy working for companies where the incumbent management is an owner-operator and they have motivations that are completely independent of the minority shareholder motivations and not allowing the activists to get in? So I'm thinking like in countries in Asia where a lot of the companies are owner-operator companies, they really have really different motivations. And even though it could be cheap on acquirer's multiple, what are your perspectives on why would it work in those markets when the founders have no reason to let anyone in?
You might need to look at what they're doing with the cash flows when they get them. Are they paying them out? Are they using them to expand the size of their kingdom? Are they investing them in lower return businesses? I think that it definitely does work in the US because you have that tension where somebody comes in. But I think if you look in the US and this is something that I looked at, the number of those companies that are actually taken over or have some sort of activist event occur is actually still quite small. It's only about 1 in 20. And so for the other 19, it's simply that mean reversion in the business that generates the returns. So when you're looking at Asia, if you're looking at Japan, for example, where it's a fairly insular society, but there are some sort of inroads being made by American activists there. Even though that period of time where there wasn't a lot of activist activity, there still were quite good returns to those undervalued companies, even with all the cross-shareholdings. And I acknowledge that now they have been very undervalued, and maybe they're less so now over the last few weeks. But it still has worked there. I don't think it's necessary for it to work, but there are always metaphysical reasons outside the sort of realm of the back testing that I can't answer, and you're sort of going on faith a little bit. Perhaps that those markets open up too. They continue to open up and they adopt more sort of external type management because it's a globalizing world. They have to sell outside their boundaries, so they need different types of management.
Thank you so much for your talk. It was great.
Thank you, sir.